Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello viewers, in today's video I am going to talk about 3 small cap companies that are the market leader in their niches and deserve to be on your watch list. The reason I like them is not just what they've achieved so far, but the ongoing business developments and potential for future business growth. These companies have some strong moats that have allowed them to be the leaders and to expand the business potential. Now, moat is a difficult concept to rely in the age of fast disruption. You must have heard this often: there are no companies with moats in India. Well, I beg to differ. There are companies with moats, intrinsic, that protect them from external competition, make them sustainable and scalable. These are the businesses that enjoy potential for high return on capital employed and have high entry barriers because of economies of scale. They have huge market share versus fragmented peer groups and enjoy strong balance sheets. These companies have an edge over their competitors that allows them to maintain or increase profits over time. It could be reflected in the kind of clients they are able to target, the premium that they enjoy on the sales of their products despite competition, or their strong resilience as compared to peers during the industry downturns. Basically, these companies have an advantage over their rivals and can survive better than their competitors. I would like to call them small cap monopolies. A monopoly is simply a company with a large market share versus fragmented peer groups that generates huge profits from its industry and is very well managed. It also enjoys a higher, better return on capital employed than its peers. One of the key attractions for me is that these businesses tend to be low cost producers in their industry as they can operate with lower capex and opex than their smaller peers. In my experience, these businesses attract a lot of investor interest given the quality of businesses generated and the high returns on equity over time. What drives these returns is better pricing power, economies of scale, and strong quality and growth oriented management. In addition, these companies have no real competition from other players in the market, which makes them very attractive investments for growth investors looking at small caps from a long term perspective. We are in a market where fears of recession, inflation, and rate hikes can turn market sentiments negative and lead to sharp market correction. If the sentiments do turn negative, I suspect the correction in small caps will be much sharper than the large caps. And for long term investors, the opportunity to enter quality small caps businesses at lower prices will be better too. Now, investing in market leaders that are not in a saturated industry is the best way to create wealth in this downturn. Why? Because it's a safe investment with a long term horizon and excellent growth potential. You know that you are investing in something that will probably be around for many years to come, so you have time on your side as well. With that in mind, I have selected 3 small cap companies with leading market shares that I believe should be on your watch list. Please note that inclusion in this list does not imply a buy or hold view. Today's video focuses on business trends and not on views on stocks. For that, I would recommend you to dig deeper and to do your own due diligence. The first is Moltech Packaging. Moltech Packaging has a 25% market share in rigid plastic packaging market in India. Amid a highly competitive business landscape where dozens of companies and products are competing for customers' mind space, the importance of packaging cannot be ignored. As product and pricing differentiation diminishes, packaging becomes more important than ever in influencing the buying decisions of customers. Industries are willing to spend millions researching on packaging designs that not only appeal to the consumer but are easy to display and stack on shelves. Moltech Packaging is a company that has created a strong niche in this space. Now, you remember when paints and lubes used to come in greasy, leaky, smelly, and rusted tin containers? And today's where plastic containers are relief? Well, you can thank MTPL for that. The company pioneered the concept of plastic pails in India with Asian Paints. Until a few years ago, the company used to serve clients in paints and lubricant space, Asian Paints being one of its biggest clients. In fact, it has been the sole supplier to Castrol Limited as well. The other customers include Dulux, Narolac, ExxonMobil, Bharat Shell, and so on. But the biggest trigger is its foray into new sectors like food, FMCG, and pharma and cosmetics that could be future engines of growth. So, what makes Moltech stand apart from its peers, allowing it to command not just the highest market share but also a premium and better margin on its sales? There are multiple factors, all of which can be attributed to solid growth-oriented management team with a technical background. For one, it is the only company in the industry that is completely backward integrated to make molds, labels, and even robots. It is the only packaging company in the world to make in-house world-class robots, and that too at one third of the cost. Not only has this resulted in cost saving, it also ensures uninterrupted production and supply, which is critical for its clients. The company has patents for a locking system to avoid counterfeiting, which is great for brand image and scalability. Airproof and tamper evident square plastic containers with pull up spouts are some of the other company's innovations. It is the first to come up with QR coded IML packaging that helps its B2B clients with tracking and traceability to prevent counterfeiting and run promotions. MTPL has pioneered the concept of in-mold labeling concept. In simple terms, IML results in high picture quality and everlasting decoration and hence improves the brand image. It offers barcoding, but most importantly, it has better hygiene than conventional labeling as no human touch is involved. There is a huge untapped potential for this technology in India, especially in food, FMCG, and pharma space. Coming to the growth triggers, the company made a big leap a few years ago when it decided to move into food and FMCG packaging. Within a few years of its entry, food and FMCG have come to account for 24% of sales. The products it caters to include ice creams, fast foods, edible oils, ready made foods, dairy products, frozen foods, and so on. The IML based packaging offers touch free and hygienic packaging, which food and FMCG company appreciate in the post pandemic era. Its products also find applications in detergents packaging, sanitizers, dispenser pumps, shampoo bottle packaging, and online food delivery. Its clients within this industry include names like Hudson, Amul, Mondelez, Adani Wilmar, ITC, Himalaya, Nestle, Dabur, HUL, Heinz, MTR, CCD, Pepsi, Nandini, and Britannia, to name a few. The margins in food and FMCG is better than lube and paint industry, and hence the growth opportunities have come with better profitability chances. There is also potential for its products in online food delivery market. The best part I like about this company is that despite hitting several milestones, the management has not become complacent. The management team seems to be in constant exploration of solid growth opportunity. The latest opportunity that they have tapped is the pharma field. The company has announced foray into injection blow molding packaging products with an in-mold labeling for pharma and cosmetic packaging. The company's USP in this will be the use of IML packaging. The market size for IBM packaging is more than rupees 50 billion in pharma and is growing at the rate of 8 to 9% per annum. The management expects to command a 5 to 6% market share in next 4 to 5 years. In cosmetics, the company will make containers for FMCG and cosmetics sector. Being Hyderabad based and happens to be the hub of Indian pharma industry, the company has a locational advantage. The pharma packaging products will be high value added products and will keep the margins on a growing trajectory. To make the most of existing and upcoming opportunity, the company is expanding capacities and is bringing in innovation like QR code packaging solutions that could take care of the issues like adulteration and allow traceability. Besides, it can be used as promotional tool by clients. The company is way ahead of its competition like High-Tech, Archiplast, and Jolly Plastic. The stock is trading at a PE of around 40 times. The company has reported return on capital and return on equity of 23% and 19% respectively, and the debt on the balance sheet is negligible. In FY22, the company raised nearly Rs 10 billion from a QIP issue at a stock price of 740 per share. At Rs 740, the issue witnessed participation of some of the marquee investors like Goldman Sachs, White Oak India, Aditya Birla Sun Life, ICICI Pru, and so on. I would strongly recommend you keep the stock on your watch list. The second stock I would like to include in this is Mayur Unicoaters. Mayur has the largest capacity for manufacturing of synthetic leather in domestic organized segment with annual production capacity of 48.6 million linear meters of PVC, that is polyvinyl chloride coated fabric, and 5 million linear meter of PU coated fabric, that is polyurethane. MUL manufactures more than 400 variants of artificial leather from PVC polymer, which finds applications in footwear, automotive, that is seat upholstery and inner linings, furniture, and fashion items. It has clients like VKC, Bata, Action, Relaxo, Paragon within the footwear segment. Backed by strong R&D that competition has not been able to match up to, the company is known for its excellent quality products. This has allowed it to break into new clients and markets where competitors haven't. Mayur is the only company from India to supply directly to US auto companies like Chrysler and Ford and has received product approvals from Mercedes and BMW along with other auto companies like MG, Hector, Maruti, Tata, Isuzu, Suzuki, Motor, Volkswagen, Bajaj, Sonalika Tractor, and so on. While auto sector was on a slowdown and has suffered from chip shortage, the company's products have been selected for the launch of new models to be launched in FY24 and 25 that will likely boost performance. Primarily a PVC manufacturer, the company has recently forayed into PU or polyurethane, which is another substitute of natural leather. Within artificial leather, PU accounts for 60% market share globally. So entry into PU could be a big kicker for growth in the long term, especially amidst China plus one wave. You see, so far PU is mainly imported from China. However, the supply chains could shift drastically with Mayur's entry into this space with its quality products. Overall, the substitution of natural leather with artificial is likely to drive demand for companies' products. The stock is trading close to Rs 490 now. The latest buyback was in April 22 at 650 per share through tender offer route. The return on capital and equity for the company stand at 16% and 12.3% in FY22. The debt is negligible and the stock is trading at a PE of 22.5 times. The third on the list is GNA Axles. It enjoys a leading market share of over 50% in supplying rear axle shafts, spindles, and drive shaft to domestic tractor and CV segments and other off-highway vehicles. Over 50% of the revenue comes from exports. Its export markets include US, Europe, Japan, UK, South America, China, and Australia, amongst others. The business has shown strong resilience amid challenges like lockdown and steep increases in the raw material prices such as steel. Historically, the fortunes of the company were linked to tractors and CVs, but this has recently changed. The company has forayed into categories like LCVs and SUVs. Within India, from a mere 15% share of the domestic passenger vehicle industry, the share of SUV has jumped to 40% in FY22. The share of this segment is expected to continue to grow as customer preferences tilt towards compact SUVs from sedans. Hence, entry into this space is not just positive for profitability, but also de-risks the business from an overdependence on a specific category of vehicles. The business is also likely to benefit from scrappage policy in FY21 due to replacement demand. Within India, tractors are also likely to be in demand with uptake in infra and capex cycle. As a key supplier, GNXLs is likely to benefit from the same. However, the key risks to watch out for are client concentration and a down cycle in the CV and tractor industry. The return ratios are in the range of 16 to 17%. The debt to equity is less than 0.4 times, and the stock is trading at a 16 times PE. The promoters have increased stake in the quarter ended June. These were just the examples that are highlighted in the video, but if you pay attention, small cap space has enough market leaders with solid growth prospects that deserve to be on your watch list. Other examples are CCL Products, Kaveri Steel, Oriental Carbon, LG Balkrishnan, Sheila Foam, Triton Walls, GHCL, Cosmo Films, etc., to name a few. If the markets indeed undergo a correction, I believe some of these will offer attractive entry levels and could turn out to be multi-baggers in the long term. Before you pick up a small cap monopoly company, here are two questions you should focus on. First, is it growing? A leading market share is not enough. For instance, in case of Castrol, being market leader does not help much as the lubricant market itself is saturated and slowing down. An ideal business is one with plenty of room for growth and expansion, otherwise you might as well invest in large caps. Second, is the management trustworthy? You see, within small cap space, the management quality is a make or break factor. It is better to not bet on managements that have not treated minority shareholders fairly or are known to take imprudent risks. With this, I have come to the end of this video. If you enjoy, do let me know through your likes and comments in the feedback section. For more such video alerts, do subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.